you know, who pays the rating agencies? Who pays the rating agencies?
The people being rated.
The company's being rated. So is there a conflict of interest there? Yeah, I mean, presumably there isn't. It's like who pays the auditors? Well, the firm's being audited. Again, presumably there isn't, because if you're a serious company like S&P, you know, S&P is part of what? McGraw-Hill, Moody's is its own freestanding company. Presumably, the fees you're earning on one specific rating aren't going to impact your opinion. But I think there was a lot of speculation as to whether they were just being driven by the euphoria and they were giving out some very nice ratings that weren't really justified. But we'll leave that to that last class. So we've spoken about, we've covered a lot of ground. Well, you know, five very rich chapters, okay? And so, so we've talked about interest rates and how they're determined. We've talked about the impact of maturity, inflation, and credit risk on interest rates. There's some other things that impact interest rates. Taxability. So in this country, generally, the general presumption is that interest on federally issued debt is taxable for federal purposes, but not for state purposes. And at the same time, interest on state and municipally issued debt is not taxable at a federal level. It may be taxable at a state level, but it's not taxable at a federal level. So, in a state like Florida, where we don't have a state personal income tax, if we wish to earn interest that is exempt from taxation, we can buy municipal bonds. So, bonds offered by state and municipal governments, you know, at a rate. Now, because they're not taxable, they're generally going to yield lower or higher than the prevailing market rate. Lower. And so the way we get to the sort of tax conversion rate, or the, you know, tax, so we would say, you know, whatever the rate is divided by 1 minus a tax rate, right? So, you know, do the math, right? 5%, right? Assuming you're in a marginal 40% tax bracket, right? 40%, right? So it's 5% divided by 0.60. What is that? I mean, I'm worthless without it. 8 point something, right? Yeah. 8.33. I didn't want to look at my notes because it was there. Okay, so but anyway, so 8.33 is the tax equivalent rate. So a municipal bond that yields 5% has a tax equivalent rate of 8.33%, which means that if you could buy a bond that is taxable at 8.33 or below 8.33, you would prefer to own a municipal bond. Okay? If you could buy a bond of similar risk at greater than 8.33%, then you would want to buy the corporate bond. But the theory is the way yields in municipals work, they correlate back to similar credit instruments in a marketplace. Okay? So this is the tax conversion, or the tax equivalent yield. What is callability? So we talked about taxability. What is callability?
Issuer's ability to pay off.
Right, to redeem, right, to pay, right, to earlier than the maturity date. And why would somebody want to do that?
Probably interest rates changing.
Typically because there's a change in interest rate environments. Okay? And so if you have a callable bond and you issued it with a coupon of 8% and prevailing market interest rates went down to 7%, you would call your bonds, repay them off, issue the same amount at a lower interest rate and pay off the other guys. So, do you think that callable bonds have a higher or a lower yield than non-callable bonds?
Higher.
Slightly higher because there's more risk to the holder. And we'll talk about that as it relates to the interest, or as it relates to the real estate sector in the fourth class. I'm not going to get into the math. In some class you can get into what's called the option adjusted spread, and you can actually quantify what the spread should theoretically be between a bond with call protection and a bond with call features and a bond without call features. We're not going to do that, but at least you know the term.
What's the last point on the risk moratorium?
I'm not there yet.
Oh.
Convertibility. So some bonds have conversion features. They can be converted to typically a different form of security within the capital structure, typically equity. Because the presumption is that conversion feature has a value associated with it. Debt instruments with convertible features typically pay a slightly lower interest rate in the market because there's a presumption that you're going to make that up, somehow on the conversion. And then marketability just talks to the depth or the liquidity of a particular instrument, right? So it's no different, if you buy Apple, there's, hundreds of millions of shares that trade every day. The bid-ask spread is like right there, no problem. You own a bond from, the Brazilian state of Parás, water treatment plant, and you own 50% of the issuance, who's going to buy it from you? So the broader the market, so the more marketable, the lower the rate. The less marketable, the more premium that's going to be associated with it, just because of the implied risk. Okay? So we've talked about all the determinants that impact interest rates as well. Talked about all this already. I don't want to talk about swaps other than to say that you can do swaps, you can do interest rate swaps, and you can do interest rate swaps. Typically what happens in interest rate swaps, somebody who has a fixed rate swaps with somebody who has a variable rate. People do that for a variety of different reasons. In order to do that, somebody has to have a quantifiable advantage over the next one. So somebody has to have an advantage in being able to get a rate that the other guy wants, and so he's willing to give up that advantage in exchange for some value. Okay? I don't want to talk any more than that about that today. If we have more time, I'll bring you an example in a future class. I want to talk about some of the features of debt instruments, okay? Bullet maturity means what? It's all due at one point, right? As opposed to, some sort of, periodic amortization, right? Balloon payment means what? The remaining principal is due at the end, okay? Coupon, we talked about coupon. Coupon is the periodic interest payment that's made. If a bond yields no interest, it is sold at a discount, okay? It is sold at a discount. And so it is called a zero coupon bond. So, again, you get it based on whatever the prevailing market conditions are, but it may have a face value of 100 and it sells at 93, okay? Because that 7% spread interest you're going to make in appreciation as you get closer to maturity, okay?
What did you say after balloon? What was the
Zero coupon bond. This. We talked about this, we talked about that. Instruments that trade above their face value are called premium bonds. Things that are sold below their value, face value, are called discount bonds. The implication is that premium bonds have prevailing market rates that are what? Lower?
higher?
Lower than the coupon. Okay? Discount bonds, is that the prevailing market rates are higher than the coupon. And the price of the bond needs to adjust. The example that we used earlier, market rates went from 8 at the time of issuance to 10. The bond has to sell at a discount of $200 of 800 in order to yield that from the fixed stream that it has. Other terms that, you know, were thrown about or discussed. Maturity, when we talk about treasuries in particular, we throw around a lot of different terms. Bills, T-bills, different definitions, but typically less than 1 to 2 years, okay? Very short term in nature. When we talk about notes, we talk about maturities between 2 and 10 years. And when we talk about bonds, right? Long bonds and all, long bonds 30 years, or but bonds in generally are 10 years and greater. You know, the book talks about things, collateral trust bonds, equipment trust certificates. Typically some specific collateral is set aside to guarantee the repayment. Debentures and subordinated debentures, so debentures are general obligations of the company. They're not guaranteed by a specific asset. Subordinated debentures are the same, but they're subordinated to all the other creditors. So when you see subordinated debenture offerings, that's about as low in the pecking order as you can get before you get to the capital stack. Yes, sir?
What's an example of an unsubordinated debenture? I have no idea what a debenture is.
Don't you work at FP&L?
Yeah.
Well, FP&L in particular, utilities in particular, offer a significant number of debt instruments, typically not unsubordinated, okay, and not debentures, typically the other type. They'll do collateral trust or some sort of security. So again, that's why energy or energy company issued debt instruments tend to have high ratings, because there's some sort of collateral or income stream associated with them. Do you remember a guy named Michael Milken? Drexel, Burnham, Lambert? Okay, so there was an investment banking firm called Drexel, Burnham, Lambert. I'm going to say starting in the 1980s, they started pioneering or working with leveraged buyouts. Okay, so they started providing equity for companies that were, or say equity capital for companies that were, management was buying out existing shareholders. They in particular were using the instrument of a subordinated debenture. Okay, so in the capital stack, right, there would be a piece. Banks would only lend so much on high leverage deals. So, you know, maybe traditional debt might provide 30% of the capital, right? And these guys didn't have a lot of equity because they were highly leveraged deals, right? So maybe it was only 10% of the stack there. And also they come up with like 60%. And nobody wanted to be subordinated to secured creditors, right? And nobody wanted to take equity in a deal because it was so levered, right? So they had to find or create some sort of class of investor. And so these subordinated debentures, you know, sort of became the part of the capital stack that provided the money for those instruments. In today's environment, most of what we today call the high yield market, so most of the high yield debt, when you look at things like, I think it's HPK, which is like the PIMCO high yield income instrument or mutual fund, what they're investing in is subordinated debentures of companies, okay? And because they are subordinated to everyone else, right? And because they don't have any specific capital collateral, they yield a higher rate, okay? Does that answer the question? Sinking fund provisions. So most indentures, the indentures are the legal documents that govern the issuance of debt. Most indentures have sinking fund provisions. What are sinking fund provisions?
You put aside money to redeem those debentures when they come due. They're putting aside funds over time to redeem these things when they come
Okay,
due.
so I think historically that's the implication, but I've never been able to find any specific example of that. So right, it would seem that you would start creating a fund, because what happens, I loan you $100 million. Well, what makes me so sure that $100 million, in 10 years you're going to have $100 million to repay me, or that you're going to be able to refinance the debt? So why don't you start repaying a little bit at a time without giving it to me, so that it's all there? The way it pragmatically works is that companies are required to call or redeem a portion of all their debt issuances on a yearly basis. So, you know, there'll be a couple of years where they're locked out, but like starting year 2, they start redeeming through partial calls on a portion of the outstanding, so that at the end of the term, there's only a very small amount outstanding. So
that's like a contingency fund that is interest bearing, is it?
well, you're not putting any money aside, you're actually just retiring the obligation. So, you know, you borrowed $100 million, and so $100 million, right? So, you know, you start paying off 10 million, or calling 10 million starting in year 3, so that at the end there's only $20 million left that you got to pay. But you call 10 and pay it off, okay? So you're sinking, you're reducing the outstanding amount of the obligations, okay? Pull out your calculators, everybody, please. Let's go through an exercise. Do you guys have your
Yep.
You should always bring. You should always have this. You never know. Yes, sir.
There is actually a website. I think it's like the CVM calculator that you can go to.
Uh-huh. And what if you're on the street and you don't have a computer with you?
Yeah, put it on your phone. I got 12C on my phone.
There's an app, the financial calculator.
Tablet.
I'll do it with my hands.
Yeah,
So,
time value with your hands, yeah.
It's a new day. So. Hey, I'm an engineer.
Hold on.
You gotta be mobile.
I see your 12C app, and I got it too. Okay, but I like the click of this thing. Okay. So we have a bond that has a face value of 1,000, right? Because we've already said that, right? We've already said that. At the time it was issued, it had a 10% coupon. Okay? I'll ask a trick question first. If the market interest rate today is 10%, what should it trade for?
Should trade.
Well, somebody needs to trade it, right? So it should trade for $1,000. Now, if the interest rate drops, the market interest rate drops to 8%, what should it be valued at? Now, I'll walk you through this so that, you know, the coupon is what? $100, right? It's paid what? Semi-annually, right? So let's do the keystrokes if you want. So, well, is it going to be a discount or a premium bond? Okay, it's going to be a premium. We know that. Why? Because the market interest rate is lower than the coupon rate. Okay, so let's plug in. Let's plug in the face value. Let's put a negative number in front of it. Let's change the sign, and let's say present value, right? The payment is what?
50.
The payment is 50. That's payment.
Is that a negative?
Well, you can either do
Put a negative on one.
one or the other. You can do it on the stream, or you can do it on the face value. Okay. So the number of payments. 20. No, not 21. 20. 20 N. What's the interest rate? 10%. What's the I? 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. 8. we're paying semi-annually.
Oh.
Four.
Or- Wait, when you still put 8% per year?
Which calculator do you have?
I got the 10B.
Oh, I don't know how that works, man.
Oh.
Is your IY stuff as like monthly or?
Yeah, you're on a 12.
Okay, you're 12.
Oh, yeah. So then it would be, that's you got, no, so
It's twice.
Yeah, two payments per year, but I still put 8% as my annual.
yeah, no, it's 20, yeah,
Cool. Back and forth. Oh my God, I'm having flashbacks.
Where'd you get it from? Our present value, well, the present value is already in.
We already punched it.
It's true, so that's the future value.
Future value is negative. Yes, future
I
value.
got, look at this number, I know it's impossible. Two negatives, man.
Negative 11, negative 11.
Write that down. What's it?
FB on
I have no idea what it's
No.
negative one. Y is per negative.
No, yeah, it is based on.
twice a year.
This calculator works just great.
Think about it, 8% for the whole year.
I was
Yeah,
calculating
20 payments.
annual coverage. That's what I was doing for my mind.
So the future value is 72.2.
Yeah.
Now I.
That's what you trade for.
Just enter.
And then for the second set, 8%.
Okay, guys, come on. So I haven't heard any answers yet.
I got an interesting one, but I think my calculator's broken.
Should it trade for premium space value? Because the rates went down, so the value of trade should go up.
Oh, well said, yes.
Listen, so we can do it, I don't have, we can do it, you wanna see it in Excel too? That sounds closer to, I don't think it's that high.
Trying to figure out what.
So we're gonna solve for present value, right? Right? What's the rate? Right there. What's the number of payments? What's the payment? 50, right? What's the future value?
1223.
Think of this
Put
one.
the number on the top of that again. Oh, the range.
What am I doing wrong here?
Why is the payment 50?
I don't know, because it's a coupon of 10. What am I doing? This is like radically, stupidly wrong.
1163.
Okay, so what's the rate? The rate is 8, right?
Yeah.
What am I doing wrong here?
Should you multiply the 20 by 2?
No, why would I multiply
Yeah,
it by 2?
semi-annually. Oh, but you already did your.
I already did that, so
You already
there's
did
20 payments.
You get
20 periods.
101.85?
The payment minus 50 and the future value is
Break is
1,000.
Yeah, so it should be, it should be like 12.23 or 13, right?
Yeah, but that's not, no.
So that's the present value just cash flow, not including the original. Not including the 50, right?
no, I have it. I'm just saying. What about talking first?
Let's start all over again. Rate. 8%, right? Divided by 2, right?
Does the Excel function assume that you're putting in an annual interest rate?
That's,
If
let
that's the
me
case.
just do that. Let's just do it. Let's just fill it that way. Let's go.
It's shift N7 down.
How much that way to the future?
Control
Control
Alt.
just make it.
Hold on, let's see.
F2.
Let's read it. Let's read it. Hey.
Can you just make it?
Hey, Doc, this is exactly what that Principles of Finance book is for.
Okay.
You were, you were asking, okay, so future value, so what does future value say? The future value is single lump sum payment, okay? So, is this what we're looking to solve for?
No.
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 So what function should we be using? MPV, right? So let's solve for,
So you just want NPV.
okay, great.
So we can plug in some cash flows.
Yeah. So let's just plug in, let's do it this way, look, let's do it this way. Or, here, I've got a better one. Yeah.
Oh, okay,
Okay, so the rate, right?
Yeah.
That's the annual rate, right? Values,
Why divide by 4?
oh, it should be 2, I'm sorry.
So he said 10 years.
Right,
That's
2.
it.
And what else are we getting?
The payoff.
Right, so,
So it's a 10-year note.
okay, that's the value.
Piece of paper.
So the formula.
Yeah, what's the formula?
Can you say that?
No, that's what I meant. It's a 10-year term.
10-year term. 10-year term.
I got it.
So I just did a net present value calculation, right? Interest rate is essentially 4%, 8% annually, but it's paid semi-annually, right? So 8% divided by 2. Here's the stream, right? 20 payments of 50 plus 1,000, right? And the market interest rate is 8. Now, let's just change this to 10, right? If we change this to 10, what do you think the value is going to be? 1,000. It better be 1,000. Oh, it's not rounding for whatever the reason, okay? Well, actually, you know why? Because it should be this.
Yeah, there it is.
Okay? There we go.
So go back to 8%, what is it?
It should be, that's why I had it in my, it should be 1134.20.
1134.20. That's why I said it's
1135.90.
So it's
Okay?
19
Oh,
payments of
that's
50.
wrong.
So it's 19 payments of 50.
I'm gonna have to take points on
Right, 19 payments of 50 plus
One payment of
50.
1050.
Wait,
For this
No, no,
guy,
for the-
yeah.
for the last one.
Okay? People are looking like, I want to go home.
Yeah, I
The exam?
Yeah.
Why would I send you this? We just did it.
I know, what's the reasoning on why you add the 50 on the last payment?
Well, because on the very last payment, you get the last 6, so look at the timeline. Okay, so you give the guy $1,000. What does he give you in return for that? 50 and 50. 50 and 50. 50 and 50, right? So on down the line. On the last year, what does he give you? 50 plus your 50 for the last 6 months plus 1,000.
Oh, yeah, yeah.
Okay?
Oh, yeah, the entry, yeah. Because you're getting all your money back and you're getting that interest payment.
So it's like $2,000.
No, you're just getting that, you're getting your payment, but you're getting that interest along with that last, when you get that last payment. You added your face value. If you do what?
50 times 20.
So what's the problem?
This is a calculator. Do you
I
have
just
the
know why it's
12?
there.
Do you have the 12C? You have the Texas instrument?
No, I have, PA, whatever.
I have two, just where do we plug what? Yeah, I have the one you're holding.
Okay, so this should be, so it should be.
I don't know what it looked like that. Yeah.
Yes. Absolutely.
Get it right, man.
I'm sorry. Victor, buy that book that Dr. has.
I looked at the content. Means Steven's calculator preferred.
This is reference, right?
I got 2 negatives in my answer somehow. You got a bad calculator.
Tula, let me finish and come back. For some reason, I'm getting the wrong number, and I'm doing something, I'm getting something really, just give me, let me rehash, and then I'll come back and get it. Guys, let me finish, we got 10 minutes, let me finish.
You got 7.
Let's talk about bankruptcy. Like this process was just bankrupt.
19 and then 1 is cash flow, so 1,050 would be your IRR. It should be. What are you putting at?
Okay, hey, let's fit, well, let me just, I'm doing something wrong on mine, so my keystroke. Ryan, do you have the 12C?
I have the 10B.
But is it the reverse Polish notation?
It's
Or algebra. RPM
No, you know what I'm talking about.
RPM.
You punch it,
Use an enter sign.
backward.
It's
No,
reverse.
no, it's not that one.
Algebraic then.
Okay, what are the keystrokes that you put in?
Alright, so I put 8% for the I
Right,
slash Y.
right.
And then I enter cash flows, so 0, cash flow, 50,
Oh, so you enter all the cash flows?
Yeah.
Okay.
Yeah, and then, 50, and then 19 of those, you can just make it repeat 19 times, and then the final cash flow 10.
You remember?
0, cash
Yeah.
flow.
Here.
I forgot.
It is the one
But
thing
how
I
do
do
you
that
make
is-
it?
I don't remember how to make it.
It's the N
What?
sub J.
Okay.
Oh.
Okay.
Works like magic.
So what was it?
Yeah, so it's 11:35, 90. There we go.
It just came on in my, I just got the same answer of 11:35 in my calculator, and I don't know how I did it. I mean, I'm not making it up, you know?
I think I got it. I got the procedure down.
Yeah, but the thing is, we need to explain it to everybody.
I think I can do that.
You can explain it to everybody?
Yeah.
Okay, everybody listen, everybody listen.
Oh, you guys haven't done the finance class. I was gonna put it Forgy notation on the board.
You give me 40,
Alright, so
What's that?
I got the HT10B2. I know it's different from the 12C, but okay, on the 10B2, you clear out everything. I set the interest rate at 8%, so 8, and then hit the I/YR button.
At least you said it one payment per, one payment.
Yep. And if you're familiar with the cash flow buttons, the first cash flow is 0. Cash flow button is CF sub J. Next one at month number 6 is 50, so you put 50 CFJ. You want 19 of those. So then you hit 19, then the N sub J, which you have to hit on the 10V is the little red key.
Shift.
Yeah, shift CFJ.
Oh, my calculator just stopped.
Your last cash flow is going to be 1050, 1050.
Can you repeat that last?
See if let me just write it up here. I borrow a lot.
You can borrow this one, because this is for the 12C, I just got it, so.
You get 4%.
I don't know.
Everything.
It's not working. You can do that, it works. It works on all, yeah, I got it.
Okay. For the 12C, it's just simple.
My dad's
Future value. Hey, clear all first. Future value 1,000. I is 4. N equals 20. Payment is 50. And then just hit PV. And it'll give you 1135.90 negative.
I was doing reverse.
Sorry?
You put in your future value.
Yeah,
I put in future value. You're getting 1,000.
I was putting it as a present value.
Yeah, I was putting in.
No, it's future value. You're going to get it in 10 years.
Yeah,
You're solving for PV.
yeah.
And if you're going to do it in Excel,
Oh, you're saying
it's
how
the
much it's worth right
NPV
now.
function, right, equals, and so what do? You lay out your cash flow, right? Okay, so you do your intervals, right? And then you solve for
Yeah, that
rate,
works.
you answer
It's a
rate,
lot easier.
That was what he said.
and the cash flow.
How many payments?
And this is
cash flows.
what we just did here.
Zero.
50,
Oh,
50, 50, 50.
and do it.
1,000.
Except for 8% on the high slash.
Yeah? Does this make sense?
Your formula makes sense in 10B, also the future value, etc., except for the I is 8%.
On yours?
Because it's an annual interest rate that you.
Okay, because you do I for Y.
You can set it
Yeah.
as whatever you
Okay,
want.
okay.
That's the difference.
So it's all right, okay, all right.
That
But
way.
this works the same way on, okay.
Yep.
So did you guys hear what Ryan said? If you've got the 10B,
Yeah.
if you've got the 10B, you could use the same keystroke, except you've got to use I per Y. It'll automatically take you to the form.
Right, and you have to set up 2 payments per year before you start.
Okay, okay,
Sorry, that was the.
okay? Makes sense? Hey, real quick, bankruptcy. I don't know a lot about bankruptcy, thankfully. Thankfully.
How would someone in real estate not go bankrupt?
So what?
Thankfully, we've never had that issue.
What is the present
Listen,
value of
okay,
1,135 give us?
What?
What is that present value?
That's what you gotta pay for, the bond.
That's the premium rate.
That's the premium you have to pay. You have to pay $1,135 so that you yield 8% with a cash flow that you can acquire.
Got it.
Okay, there are, I think, 4 operating codes in sections of the bankruptcy code. Chapter 7 are liquidations. Chapter 11s are reorganizations. Chapter 13s deal with individual bankruptcy. And Chapter 9 deals with governmental entities that go bankrupt. Nobody wins in a bankruptcy, okay? Ultimately what happens is the debtor can, so creditors can request, 3 creditors can get together and force a company into bank. They go to the judge and say they're not paying, and it can be forced into bankruptcy. Or the debtor can go to the bankruptcy court and say, I need relief, I can't pay all these people, and I want to be in possession, I want to be the debtor in possession, and I want to create a restructuring plan. A creditors committee will be formed, the debtor will present his plan, the creditors will either approve it or not, okay? Relatively simple in that perspective, okay? Now, I want to define a couple of things. Bankruptcy is different than insolvency. Okay, we've talked about this in the accounting class. To be insolvent means what?
Disappears.
What? Okay, so technically, insolvency is an accounting term that defines that your assets are less than your liabilities. You have no equity. You can be operating in this scenario. So you can be insolvent and continue to work. You may not be able to, but the only way you can make this work is if you're not paying a bunch of these guys. Okay? So you can be technically insolvent and continue to operate. Now, if you're insolvent, the likelihood is you're not going to be able to operate. Okay? But you can. Bankruptcy is a state under which you can operate under protections from law. Okay? So you can be insolvent and not bankrupt. You can also be solvent and bankrupt. So you can have a scenario where your assets exceed your liabilities, i.e. you have net worth, but you don't have liquidity. So you can go to the bankruptcy court and seek relief to restructure your debts. Okay? Or maybe your assets aren't really worth what you think they're worth, or you can't liquidate them in short order to meet your obligations. Okay? So bankruptcy and insolvency are different terms. Insolvency, assets are less than liabilities. Bankruptcy, a state in which one goes to seek relief under the court, under the laws of the country. Okay? What happens? Ultimately, if there is a restructuring under Chapter 11, right, typically what happens is you go through a you go through a reorganization of the capital stack. And so people will typically be paid, when you go in bankruptcy, you're never gonna get all your money. Whoever's a creditor is not gonna get all their money, okay? So kind of the pecking order goes through some level of security to subordinated or unsecured creditors, right? Down to equity holders. Now, within the secured level, there's all kinds of priorities. Governmental entities will take preference. Employees will take preference, right? So unpaid wages and all that will be paid first. And typically what will happen is there will be some level of payment here. So, I mean, every plan is unique, but what you tend to see in large bankruptcies is some percentage payment here and some sort of pushing of this down into an equity component. So you kind of get pushed aside to be a residual equity holder. Now the creditors can approve it or not, the bankruptcy judge can approve or not. But the goal of creating a reorganization of the capital stack is to give the company a fighting chance to live another day. You don't want to go back into bankruptcy again. Okay? Does this make sense? Last thing. We talked about the high yield sector. The other thing I wanted to say is people look at the spread that exists between highly rated and speculative debt, that ratio, that proportion as a sign of the economy. As this ratio tightens, right, as the spreads get tighter, there's a presumption that the economy is going to do better. Why? Because these rates go up higher. Why would they go up higher? People think there's less risk associated with them. As that spread widens, what's a presumption? Worse times are coming ahead. There's more risk associated with speculative debt, higher incidence or potential of bankruptcy, default. Okay? The bond market, all I want to say about the bond market is institutional in nature. That there's some movements to try to make it a little bit more accessible to individual investors, but it really isn't. We talked about that earlier. And the last thing I want to talk about is preferred stock. Preferred stock is neither stock nor debt. It's both. It's neither or both. So it has features. It has fixed payment features like debt, but it has no guarantees. So it's kind of like a residual equity holder in that sense. There's a coupon associated with most preferred stocks. Some of these preferred stocks have the same issues. There's callability, and there's conversion features associated with most of these preferred stocks. Preferred stocks tend to be held by companies because their interest or their coupon is exempt from taxation, and that's to avoid triple taxation. So dividends typically pay tax twice, right? The company pays tax on its earnings, and then the individual that receives a dividend also pays a tax. I'm sorry?
Is it Cap Mkts?
No, it's ordinary income. They're getting dividends. Now, there's been some preferred treatment on some dividends that they're qualified or not, but there's a double taxation imposed. The company pays and the individual pays. So, to avoid triple taxation, a company pays preferred stock dividends to another company. Those dividends are exempt from corporate tax, so that when they get distributed, okay, there isn't taxation here, here, and here. Let me check one thing. Just got to check one thing. because I'm either gonna send you home or I need to cover one additional subject. Guys, sit, relax. Okay, so, listen. I'll go over, so we talked about the weighted average cost of capital the other day, right? So we talked it was a proportion of, debt and equity, right? So if we want to call this total capital for something, so the weighted average cost of capital would be debt over total capital times 1 minus the tax rate plus equity, well, the proportion of debt over total capital times the cost of debt times 1 minus the tax rate, equity over total capital times the cost of equity, okay? That's all you need to know. I do want to spend a little bit of time.
That's all?
That's all you need, that's
Because
just.
that's English. That doesn't mean
It's
nothing.
not, it's not even.
Something to make out your letters.
So the proportion of debt over the total capital structure multiplied by the cost of debt times 1 minus the tax rate plus the proportion of equity over total capital times your cost of equity. And what we said that was cost of equity, we could use either Cap M, right? Or we could use the Gordon dividend model. And you don't need to know this week. I'll go over that next week. I'll go over how we can estimate cost of equity next week. Okay? This is, you don't have to do this. This is in the slides I already sent you.
Oh, yeah?
Yeah, obviously you didn't read them. You don't need to take a picture. This is in the slides. We went over this. I drew this up last week and it's in the slides I already sent you.
Oh, you did?
Okay, now. So. Listen.
But that's all you need to know.
Listen.
Okay, just write that for record.
Okay.
When are you signing the midterm question? Via email? Right now?
Right now? Now, we weren't able to cover, there was one module of about, there's a module that we didn't get to cover. Guys, there's a module we didn't cover today, but we can cover that the next time. It's relevant during the equity section, so probably a better time to do it. Those of you who have presentations in 2 weeks, please try to get on a call or send me your agenda. I travel starting Tuesday, so what happens is it's just very difficult for me. I likely will not have ready access to my email. I'll be able to check, but I won't have ready access. So try to get your outlines to me Monday if you're not going to be on a call Tuesday morning. Now, exam. So I'm not going to change the suggested questions that I gave you. Notice, I am not going to change the suggested questions. So the questions will be the sample questions that I sent you.
All of them?
Relax. If you want to do all of them, you can. But you don't need to. You don't need to. I have taken the time to generate a random sample question generator. You are each responsible for 6 questions. Each one of you have different questions assigned to them. please do the work on your own. I will find out if you do not do the work. If you try to find, oh, who's got the same questions that I have or whatever, it's first of all, you're gonna like spend a lot of time doing that, and second of all, I'll be able to see it. Listen to this. I listen so that there are no unmet expectations. I'm going to grade this while I'm on a very long plane trip. I probably won't be in a good mood. So if you give me good answers, thoughtful answers, well-detailed answers, the likelihood of getting a good grade increases. If you give me, what's the question? Explain how the existence of financial markets improve efficiency. Financial markets made the allocation of funds very efficient. Question number 2. Explain the role of financial intermediaries and how they provide at least one of 4 functions. Financial intermediaries provide allocational, operational, informational, and pricing efficiencies, period. That doesn't work. That doesn't work.
How long of a response do you want?
If you would have read the instructions that I gave you, there is a guidance. Well, that's the attachment to the email. Did you read the email? What does it say?
250 words, 250 to 500 words.
As a guide. Now, if you have a calculation, you're not going to do 250 words. Okay? But I don't want to show you. I will show you one of these questions I had when I did my master's on one of these questions. And I'll show you when I'm done my answer. And it wasn't 500 words. It's a lot more than that. Okay? It's a lot more than that, and it included a bibliography, and it was submitted within 24 hours. I'm giving you guys 72 hours, okay, or 48 or whatever. Listen, Claudius responded to me the other day and said, I think that all exams in a graduate setting should be take-home. I don't know that I totally agree, but I think there's a room for them and a space for them, and in a class like this, it could definitely enhance the learning. You're going to put into it what you get out of it, or you're going to get out of it what you put into it. You give me garbage, you're not going to get anything out of it. Okay? Don't go to Wikipedia, don't go to Investopedia, don't plagiarize or copy other people's. If you use reference, which I want you to use, document it. I don't care how hung, I don't want to get that hung up on bibliographies and all that, but use some recognized method of documenting other people's work, okay? But I'm looking for thought. I'm not looking for regurgitation of the notes that I sent you. If you take my note on, weighted average cost of capital, and all you do is per San Miguel, boom, and copy and paste that thing, are you technically right? Yeah. Did you learn anything? Probably not. And that's what you should do. Yes, Noah?
I always kind of wondered this, but how do you determine what is common knowledge versus not?
There's a little voice inside of you that tells you that. There's a little voice. And when you go to sleep after you submitted a test, you're like tossing and turning all night, there's something going inside like this, you probably should have done.
No, I mean, if I start just saying stuff, and to me it's common knowledge, I don't know where I got it.
Find somebody else who said the same thing and cite them.
The suggestion, Victor, I'll give you, the suggestion would be that you formulate answers that require thinking by either going to the textbook or other sources that provide the frame of reference for your question. As opposed to, I think, I believe, from my wealth of common knowledge. Okay? Yes, Victor?
So that you're saying that what you're requiring is for us to give you the answer, but not just what we're learning from here, from somewhere else, like a journal. That's what you're saying.
Well, first of all, what I'd like you to do is, let me look for something here. Look, Victor, Victor, most of these questions talk back to something that was addressed in the textbook.
Right.
I would start by going to the textbook. To the extent that the textbook has a complete answer, you probably don't need to go any further than that. But to the extent that the textbook does not have a complete answer, then you may need to supplement it, you know? So, I'm not saying to go to a journal necessarily, okay? You may want to start with a Google Scholar search and read a couple. Listen, time is limited. You have 6 questions. You know, it might take you 3 hours to do this without texting in the middle, Rebecca. Without online shopping, Rebecca. Okay? Okay, without spending your $100 in the middle. This is a focused 3 hours of like pumping.
So we appreciate it.
No, look, it should be easier than.
I am when you say that we do learn more.
Yeah, I think we do.
The class we had before this one, we had a take-home final, and I feel like we learned a lot. And we had, like a book, and then we had this one.
So, the 24 NOVA ID numbers are here, and the questions that are assigned to you are here, so just jot them down. Jot them down. Hey, listen, no, don't take pictures. Do not take pictures of this. Take a sheet of paper, because if you take pictures, then you're going to go find out, oh, well, who else has... Do not take pictures. Take a sheet of paper.
I don't know my NOVA number.
How can you not know your NOVA number?
I'm a veteran. Is it on our call? Is that your ID card? It's on our ID card.
It's not?
Come on. Wait, I need to know.
I don't know what it is.
I could probably tell you what it is.
Can you tell me what?
That's too
If you don't know your NOVA number, I'll give it
It's
to you.
too big of a deficit, man. We're gonna get him at 10 points.
NOVA number all over.
Yep, that's it.
Stop taking pictures of it over there. Hey, I want that in plain view. I don't want to take pictures of it. Hey.